Again, this is at the national level. Again, it's very isolated. In the subprime market is where most of this very risky lending took place, but the subprime market only makes up 9% of all homes in the United States. But it accounts for more than half of all foreclosures. And even within that, within the subprimes, it's the subprime arms. Again, these risky products that people were assuming prices would continue to rise and they could refinance. And that's the sector that we're getting stuck with. The vast majority of financing in this area, in Syracuse, comes from these products: prime, VA, and FHA. And this is important because FHA is the hallmark of a stable, healthy market. If you can use it, that means that the relationship between buyers and sellers hasn't gotten out of whack. To give you an example, back in 2003, I tried to buy a home in Washington, D.C. using FHA financing, and I was literally laughed at. The seller had so many people in line, they didn't even have to worry. With FHA loans, there's a stigma of a lot of extra paperwork and a very onerous appraisal process and a lot of expenses for sellers. The sellers don't like to work with them. A lot of that has been eliminated, though, over the last few years. There's been a lot of reform. So what was going on in D.C. is FHA usage just plummeted. You couldn't use an FHA loan in the vast majority of the city. And it was because sellers just had their pick of the litter, and they didn't have to waste their time with people using FHA loans because the buyers and sellers were way out of whack. That's not what happened in Syracuse, and I'll show some slides on that in a minute. In terms of foreclosures, again, the state, we've seen nearly a doubling in terms of the foreclosure rate, but we're still below the national average, and it's not representative of the state as a whole. It's, again, heavily concentrated down near New York City and the outlying suburbs. So who's really hurting from this? Again, apart from Wall Street and a few main streets, again, but down near the city, Main Street Syracuse isn't feeling the effect of this unless you're holding stocks in some of these companies. It's the bankers who are really getting hurt by this, and people hold those bank stocks. So what do we know for 2008? What are we expecting? Well, what we really went through at the national level so far is a transition from an extreme seller's market to a seller's market and then to a horizontal market. So we're in between, and we're not quite moving towards a buyer's, or weren't moving towards a true buyer's market. We were stuck in between, and there was lots of consternation and lots of worry. Moving towards the end of 2008, that subprime meltdown actually helped the market because it pushed leverage to the buyers, and it helped move that transition from the in-between to a true buyer's market, and it's very important. There's an entire generation of buyers and sellers and realtors and mortgage brokers and builders who never experienced a buyer's market. I've heard the crack too. There's also a generation of economists who haven't experienced that kind of market, but it's very important. As prices shot up in the DC area, it was expected. You would see the price of a home go from $100,000 to $150,000. Well, that monthly payment at 6% on a 30-year fix would go from $600 to $900. Okay, huge jump in your monthly payments. And so what became normal, since you couldn't use FHA, was people would say, well, you know what I'll do? I'll use an ARM. Because the rate on an ARM was down in the high threes, around 4%. So they'd knock you back down around $600, $700 a month. And then my price will keep appreciating, and I'll be able to refinance in a year, and everything will be okay. That was the gamble people were making. Let me keep going. And they lost big. Again, not part of the story here. So the story for 2008, we really need to impress upon a lot of the local markets around the area is that the national story does not tell theirs. It's very different. There's an opportunity in 2008 because of the very strong improvement in affordability. Again, the national picture is not representative of what's going on locally, and so that's why we really want to lean on the local data and the local interpretation, of course, your local professionals. Nationally, we always hear about this sharp increase in the spread between home prices and incomes. This is nationally. There's clearly a wedge there. Here locally, we haven't seen this sharp run-up in prices. It's much closer together. And that's good. Again, it just reinforces the point that affordability is very strong here. The thing that argument ignores people were arguing because of that spread there should be a very sharp decrease in prices. The thing that ignores is the strong decrease in mortgage rates. Remember, that was the thing that stimulated all the demand in the first place, and it was because monthly payments came down. Okay, so if you're focused on prices or incomes or interest rates, you're looking at the wrong thing. You need to focus on monthly payments because that's what determines whether you can afford that home. And so that's what we look at. We look at the monthly payment as a percentage of income. And this is what was going on at the national level. So as we moved along, mortgage rates came down. All of a sudden, affordability improved. These monthly payments came down. And of course, prices got bid up. We were right there along this national, very, very clear national average developed, where people were saying, okay, I need 80% of my income to finance the rest of my life. You know, paying for my kid's school, paying for the car, gas, food, et cetera, everything. But it's very clear. Every time interest rates would come down, prices would get bid up, boom, they'd hit that line, and it would choke off demand and price appreciation. Until 2006, when we didn't have an option, or we didn't have any say in the matter, and that's when mortgage rates went over 6%. They went from about 5.35% or 5.3% up to about 6.8%, and then bounced around 6.8%. So a huge increase in mortgage rates, very sharp decrease in terms of affordability, and not surprisingly, monthly payments rocketed up. So we were still seeing price appreciation, these jumps in prices during that period, and at the same time we were seeing mortgage rates increase. But again, this isn't representative of the country as a whole. Not all areas were showing those very strong price appreciations, and we're not seeing the decreases now. But you don't hear about this in the news. In terms of the 150 markets that we monitor, including Syracuse, half of them are still showing price appreciation. Of the little bit, about 285, 287 that OFEO, it's a government agency that monitors local prices, about 70% of them are still appreciating. But the one index that the media tends to focus on is the Case-Shiller index. They're both famous professors, Robert Shiller being at Yale, only focuses on 20 markets. It's very narrow. And of those, about 3 of them are showing price appreciation right now. So it's a very skewed perspective of the nation as a whole, not representative of the Midwest, a lot of the central states outside of the high-priced markets like New York. So if you were to look at Pittsburgh versus Philadelphia, at Syracuse versus New York City, a very, very different perspective.